Welcome to this week's Coffee Chat. This is Gerrod Galliano and Ernie Burns with Burns Estate Planning Wealth Advisors. Today, we're going to talk about products that you've heard about, but out in this market right now, we're going to talk more about them. So FIAs, Fixed Index Annuity products. We're going to talk a lot of detail about this product. So if you've looked at it, considering maybe sitting down with an advisor or an insurance agent now, we're going to tell you the differences there, fiduciary, non-fiduciary. But we also going to talk about the products themselves and what's happening. First, Gerrod, let's talk about this current stock market because we're duly licensed. We are security advisors as well as financial planners. Let's talk about this market first. It's not healthy right now, right, guys? We've seen a downturn this year of over 30% in the NASDAQ, 25% in the Dow, 22% in the S&P 500.
Yes, unfortunately, right now, people are feeling the pain and they're coming to us and reaching out and asking, what's out there? What can I do? And I want to know more about these fixed index annuities and what they're all about.
Yeah, because we've talked to several clients now. The way we invest, we don't have the same risk as the overall stock market indexes. So our clients enjoy less risk than, for example, that you see on the Dow, the NASDAQ. They don't have as much risk. So, but they've also reached out because of factors. Their accounts are down a little bit, but they've also reached out. Is there something else we can find that has a conservative growth model and it's insured? Well, there is. There's several different types of annuities. What we're going to talk about today are the most popular and the least expensive in some cases, in all cases, compared to variables we never offered. So let's talk about that first. It's a good tool in the toolbox. Now, we're not suggesting you take all your assets. Once we explain this, it's going to sound really attractive to a lot of you. We're not suggesting you put everything into an index annuity. But we are suggesting this is a good tool in the toolbox. So first, Gerrod, let's talk about why fixed index annuities have become so popular.
Number one, you have to go to the safety. That's the number one reason people say, if I can get my principal protected, what's that do for me? It makes my retirement more predictable. It makes my assets more predictable, more safe. And you can feel like I now have something I can plan around because you know what's going to be there next year, either what you put in it or more. So that's number one.
And also, I went out of order here, define an index annuity. Let me define one. So an index annuity is a contract with an insurance company. You want to find A or A plus or better, maybe A plus plus with S&P and AM Best. Point of Tech is a very reputable company. You want to make sure you're with a fiduciary firm. That means when you walk into that firm, they have your best interest at heart, period. You walk into a butcher shop, if you just go into an insurance agent, a lot of times, you're going to walk out with a steak. Now, the quality of steak is up to that advisor in that firm that he works for. He's limited on the products and services he can offer. You walk into a fiduciary firm that is duly licensed in both fields or many fields. You walking into a Rouse's, you walking into a grocery store. So you come out with a basket full of options. That's what we offer here because we will make sure that as a fiduciary, we're giving you the right products for yourself that you're interested in. So the definition of an index annuity is something that is actually a contract with the insurance company that's insured, and you're linked, and that's how we're going to get into this. And you're linked to different indexes, maybe the S&P, the Dow, the Barclays, the NASDAQ. We ran into the last couple of years, which has been really strong. Now, I know the NASDAQ's been hit this year, but what a great time to buy into a NASDAQ if your time duration, in other words, you're not retiring for another 5, 10, 15 years, maybe or more. Next, Gerrod, how does an index annuity work?
Well, you always want to think about it.
I kind of hinted towards it.
We look at it like it's at the insurance company. So people always say, how can I have no risk? It's because the money is not invested in the market. It's at the insurance company, and your growth is based on an index.
Yeah, you're buying options. They're buying options for that index. Let me give you an example. Mm-hmm. Let's say the S&P is at 4,000. They're buying an option that S&P 500 would get to 4,500. If that S&P gets to 4,500 this time next year in 1-year intervals, sometimes there's 2-year intervals we'll talk about too, then the option is exercised and You and the company make a gain off of it. Now, if the option is not exercised, then because the market goes down, as we've seen half of this year so far, then the client makes zero return, but also zero loss. Unlike a stock or a mutual fund or investments overall, and as securities in the sense that you actually are down not only interest and gains, but you're also principal value down. So the index annuity offers you ability to invest in the stock market, but without market risk. And like Gerrod said, your money's never at risk because they're now actually buying into the index. So that's the safety thing he just talked about. Next benefit is tax deferred. That's a win-win benefit. So you put your $100,000 in, and you do a 5 or 10 or 15-year contract, completely up to you. It's tax deferred each year, so therefore interest, not dividends, okay, not capital gains. In an index annuity, interest is compounding each year. Interest on top of principal, interest on top of interest, and interest on top of taxes that would have been paid, now growing for you. So it's triple compounding. So being tax deferred, you do not pay the taxes on it until you draw it out. So it compounds much faster. Alex, what's the next reason?
So we also...
Alex, I'm sorry. Gerrod.
So the other new guy. So look, probability of success, guys. When you're planning for your retirement, what's a big risk? People always say, what I don't want to happen is I call it a day and the market goes down 30% that year. Guess what? That just happened to a lot of folks. What's the FIA or what's the fixed annuity bring to us? It increases the probability of our retirement being successful for certain folks because we can now say a big chunk of our assets is not going down. It helps us to plan. And once again, with the tax control, we can decide when we want to pay some of those taxes. We can decide when to harvest some of those gains. Overall, nice vehicle for control, nice vehicle for protection.
Good point. Next reason, index caps and no caps. And this is important. I've been offering index annuities since the early 90s. Okay. So I've seen these products evolve through the years. And what's happened is these insurance companies have competed against other insurance companies, and the products have gotten stronger and stronger and stronger and stronger, better for the client. And as a fiduciary firm, that's a win-win. So therefore, they have cap structures now, and with interest rates going down, the 10-year bonds are going up. That interest rate going up has really put a gas tank to these insurance companies right now. So these cap rates are going up. However, so your cap rate's going up, which is really strong. We have some caps right now at 7%. Mm-hmm. But the benefit of the products now in the competition, there are no cap products now. There are no cap products. No cap products in the 1 year, no cap products in the 2 year. The NASDAQ, look at the NASDAQ the last 10, 20 years. Look how it really the last 6, 7 years, how it's just evolved and going straight up, except for this year. Point take is the market's done really well, and technology is only going to grow in the future. So when you sit down with your advisor or an insurance agent, make sure that you are looking at a no cap strategy or at least higher caps than a regular cap product. What's the next reason?
So these annuities can be kind of like a car where you can customize them to a very, very specific degree. So just like an average person going into retirement has their own specific needs, income needs, growth desires, all that, these annuities can really be tailored to that specific person, including fees. Some people want to pay a higher fee for a higher potential return. Some people are very fee conscious and don't want to pay a fee at all. These annuities can be custom to those needs. So don't go in to one place that sells one thing. We really encourage you to look at what's out there because they're very different.
Make sure you, like I said, a fiduciary firm. And that's a great point. So there's index annuities with, like you're saying, no fees, and there's some with some fees. And here's the deal. Even the index annuities with, say, a 1.5% fee is a whole lot less than it's insured than a variable annuity, which has twice the number of fees, 3 times the number of fees, and it's not insured. So we've never offered that. Okay. Mm-hmm. Income option. So in the index annuity, you can, as Gerrod said, you can build your annuity with or without. One thing that an index annuity has, an option a lot of products do, as an income. So therefore, you turn it on as the income the rest of your life. For example, let's say, for example, you put $100,000 in, and in a 10, this is an example, in a 10-year span, it does 7%. So in 10.2 years, the money doubles. Now it's 200,000. Now you're 70 years old. And you say, you know what, Gerrod, I just want to activate the income in this for the rest of my life. It's not annuitization. It's different. It's an income. This lifetime income will pay you that 200,000. And let's say the insurance company thinks your life expectancy is 90 years old. They will pay that $200,000 out by the time you're 90. If you live beyond that, they would keep paying out of their own pockets, which is a win-win for you. It's a personal income guaranteed a lifetime. If you pass on early, say, God forbid you pass on at 80, 10 years prior to 90, right? Whatever's remaining goes to your heirs. Goes to your heirs. So different income options. Gerrod, what's your next feature?
Just a little further on the income options. It's kind of like where some people like to take on the risk themselves, and then they can decide how much income to take from a big pool of money. Some people don't even want to take on that risk and say, I want to know exactly what I'm going to be getting.
And that's why we build financial plans. Okay. We have the license for the stocks, the bonds, mutual funds, annuity stuff, and life insurance. The big thing is we build financial plans. So therefore, it's a good tool in the toolbox. But let me give you another reason, and the last reason I got here: long-term care, home health care benefit options. So some products out there will have a rider that will pay additional income for 5 to 10 years if you land up in a long-term care facility or you need home health care assistance. And it works just like a long-term care rider or policy in a sense of this. If you can't do 2 to 6 daily activities, if you can't do 2 to 6 daily activities, cook, clean, dry, baby, soak, dress yourself, use the restroom by yourself. If you can't 2 to 6, the income option's activated. Now, it is not health insurance. It is not long-term care insurance. So therefore, you're not paying a premium and you don't have to qualify for it. It's a rider built into the investment. As Gerrod said earlier, is how you want to build that index annuity. And Gerrod's new with this, but he's been in the business a while. But what he knows is that we can, as a fiduciary firm, this is one reason he's here, we can customize that product for you in the manner that you wish. We have some of you listening out there might be, 40, 50 years old, or even 60, like, I don't need this pool of money for another 10 to 20 years. We can put that aside in a NASDAQ index annuity and grow very well over the next 10, 20 years. Or some of you out there might be, for example, 65, 75 and say, I don't need this for a little while, but I could use the income maybe down the road. And I like that income rider and that long-term care rider. Then we could customize that product for that. So with the uncertainty in the market, Gerrod, right now, this could be a good product for you, a good tool in the toolbox, because the forecast for the rest of the year, as you've heard, is going to be volatile. With the Feds raising interest rates to control inflation, I think that's going to tailor in towards the third quarter, and inflation should be under control by then. And we'll see a slow turnaround in the market going back bullish. However, we have these downturns in the market every 5 to 7 years. So maybe it's time to sit down with the fiduciary firm, and Burns Estate Planning Wealth Advisors can help you out with these exact products and others. Thanks for watching and Coffee Chat.